Hello and welcome to the ADM Investor Services Weekly Market Kickoff. Please note that the views and opinions expressed here today are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or Archel Daniels Midland. Today's panelists are Mark Bowman, our Global Markets Specialist, JP Steiner, our Associate Economist, and Mark Soderberg, our Senior Ag Market Specialist. Starting with the grain markets, Mark Soderberg, what are your expectations for Thursday's USDA reports?
Well, the Reuters polls shows traders expect very little change in the old crop ending stocks for both soybeans and wheat, with the estimates holding very close to last month's 841 million bushels on the soybeans and 350 million bushels on the beans. I look for a 10 million bushel increase in wheat stocks on lower exports. I see no change to the soybean ending stocks. I wouldn't be surprised to see a little bit of an uptick on the soybean oil exports, perhaps up another 100 million pounds, up from the current 2.4 billion pound forecast. For corn, the average trade gas, that's looking for a 25 million bushel cut to ending stocks to 1.39 billion bushels. And that's exactly where I'm at. I've got there by looking for a 50 million bushel increase on the exports, while a 25 million bushel cut on the feed stocks, feed usage. On the new crop balance sheets, probably not going to see any changes on production for both corn and soybeans. We got the acreage report here at the end of June, and then wait another month or so to get a little bit deeper into the U.S. growing season before we see a change in yield. So for beans, I see no change to new crop ending stocks, and neither, keeping those at 295 million bushels. For corn, I see that 25 million bushel less coming in from old crop ending stocks, carrying in right to new crop ending stocks down 25 million bushels as well to 1.775 billion. And that's pretty much in line with the average trade guess. I think there could be an argument for lower corn exports given the slow start and expectations for a bigger crop in Brazil. But for right now, I'm going to no change there. For new crop wheat, we're also going to have a production update here from the USDA on the winter wheat. The USDA has raised their winter wheat forecast every year now in the month of June for the past decade. So I'm going with that trend here. I'm up 13 million bushels to 1.934 billion. That's about 10 million above the average trade guess. I've got ending stocks close unchanged, however, as I expect new crop exports will actually be up 20 million bushels, pretty much absorbing the higher production and the higher stocks from last carrying over from the 24-25 marketing year. And the only changes I've got on the South American production is a 2 million metric ton increase on the Brazilian corn forecast to 132 million metric tons.
All right, Mark. Do you expect much price volatility in the ag space surrounding this week's trade talks with China?
I really don't think so, Jeannie. Well, you can't rule it out. This week's meetings are likely to be the first round of several rounds of meetings. The early focus for this week's negotiations seems to be focused on China's rare earth metal exports to the U.S., while the U.S. high-end computer chips exported to China. Not a whole lot of mention of China satisfying phase one of this trade agreement on agricultural purchases from 5 years ago. While I think these trade talks will eventually evolve to cover their ag imports from the U.S., however, I think this will be further down the line. China did import a record amount of soybeans here in the month of May. However, nearly all of those came from Brazil as their harvest started to advance. So right now, I'm guessing the markets are expecting some sort of compromise between the two largest economies. In the short term, it just seems like weather will dominate trade, and any big swings in the markets be driven by U.S. weather, which right now is not threatening.
All right, thanks, Mark. Moving over to the sauce, Mark Bowman. U.S. oil and gas rig counts have had some dramatic moves last week. What does this mean for oil and gas prices?
Okay, so the Baker Hughes rig count comes out Friday afternoons, and Friday showed U.S. oil rigs in operation were down 9 last week to 442. This is down from 492 a year ago and is the lowest since October 2021. This might be an indication that U.S. wells are responding to higher OPEC production and the threat that has to U.S. exports to Europe and Asia. Now, the same report showed natural gas rigs in operation were actually up by 5 last week to 114. This compares to 98 a year ago and was the highest since March of last year. But that drop in the crude rig number brought the total rig count down to 559, which is the lowest since November 2021. And this could mean that the joint oil and gas rigs combined were actually down. And this could actually limit natural gas output despite the increase in the gas-only rigs. Now, it's important not to read too much into the rig numbers alone. Less productive wells are likely to be removed from operations first. So even though you have smaller rigs, if you get the larger rigs, still can produce more. But this could matter on the margins and provide support not only for crude oil, but also for natural gas.
All right. What impact could the Unica report have on the market this week?
Okay, so this is in the sugar market. On Friday, July sugar took out its January low and traded to its lowest level since March 2023. It also fell to the key 618 retracement of the long-term rally from the 2020 low to the 2023 high. So it reached a key target level, and the market had been under pressure due to this early arrival of India's monsoon this year, and that monsoon is essential for development of sugar cane crop in India. And but it did pause last week, but it's due to resume its advance this week. And also the Southeast Asia monsoon rains are looking pretty good there, and so that's buoying attitudes towards Thailand's crop. So this brings us over to Brazil, which is the largest producer in the world. And the Unica report this week, we expect it to be released this week. It usually happens by the 15th of the month. That report will cover the second half of May. And the harvest so far has gotten off to a slow start. The last report showed that as of May 15th, cumulative crush was down 20% from a year ago, and sugar production was down 23%. And this has been attributed to heavier than normal rains in late April into early May. But now we've had some drier conditions emerge in May that should help harvest and crushing activity. Now, Brazil had a record drought last year, and there were concerns late last year into early this year that would have affected cane planting and development. We even had wildfires last fall that affected cane fields. So if we see production continuing to drag behind last year on a per time frame basis. So if the report this week shows first half of May still dragging, that could maybe switch attitudes towards, maybe this has less to do with some heavy rains in the early part of the year in April, May, and possibly more to do with residual problems from last year.
All right, thanks, Mark. Moving over to JP. What did Friday's labor report tell us?
So the May jobs report showed that the U.S. labor market added 139,000 jobs in the month, while the unemployment rate held flat at 4.2%. The figure was above forecasts of 126,000, but down from April's reading of March's reading of 147,000. May's reading of 147,000. Painting a picture that hiring is slowing as companies move cautiously on headcount while they navigate a stop-start trade war and the broad immigration crackdown. Notably, too, is that the steady unemployment rate masked a sharp 696,000 person drop in employment in the survey of households that the measure is based on. That was because the labor force participation rate, the share of working age population that's either working or looking for work, slipped to 62.4%, down from 62.6%. So absent that decline, the unemployment rate would have risen. Also, the tariff-sensitive manufacturing industry shed a relatively small number of jobs, while construction and transportation and warehousing, which are also sensitive to tariffs, added a relatively small number of jobs. Many companies are reluctant to conduct mass layoffs, in part because they had to scramble to find employees after the pandemic, and quite frankly, because they do not know if they're going to need to hire or lay off more employees given the uncertainty. Many companies are also leaving jobs unfilled. In other words, workers who already have a job are in pretty good shape, and those who are looking for a job might have a tougher time finding one. One potential sign that companies are adopting more of a cost-cutting stance without firing full-time employees is that temporary help services hiring dropped in May. Temporary workers, typically employed through staffing agencies, are easy for companies to bring on board and easy to let go. For the Federal Reserve, the May jobs report will do nothing to change its wait-and-see stance. Officials will most likely spend the summer observing how changing trade policies influences businesses' hiring and pricing decisions.
Last question, JP. What will today's trade talks with China entail for the financial market?
So as Mark touched on, export controls will be at the top of the agenda in today's trade talks between the U.S. and China. In recent weeks, the trade war between the two countries has veered away from tariffs and instead focused on each country's restrictions on materials or products the other side needs. The U.S. is set to press China's representatives to speed up exports of rare earth minerals and magnets containing them, as they agreed to in Geneva last month. The Chinese team, on the other hand, will push Washington to remove restrictions on the sale of jet engines and a variety of technology and other products to China, such as ethane, which is a material or product, I should say, used to help manufacture plastic. President Trump on Thursday had a phone call with President Xi, saying afterwards that there should no longer be any questions respecting the complexity of rare earth products, although the White House didn't give any further details as to what the Chinese side said about rare earths. And Beijing has continued to urge the Trump administration to remove its trade restrictions on China. China's Ministry of Commerce said on Saturday that it had approved a number of export licenses for rare earth-related products, citing rising global demand driven by such industries such as robotics and new energy vehicles. Really, only time will tell how well the negotiations go, but markets will be paying close attention for any positive news and closely analyzing statements from both sides for their potential repercussions on the global supply chain.
All right, thank you all. Remember, the views and opinions expressed here today on this video are solely those of our guest speakers and should not be construed as the views or opinions of ADM Investor Services or ADM. If you'd like more information about our brokerage services, please visit admis.com. Thank you.